check.
Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Real Investment Show. Of course, it is Monday as we really kind of kick off a full week of December here. Of course, Friday was actually December the 1st. The reason I know that, wife's birthday, can't miss that. So, yeah, 39 again. Yep, holding steady, looks great. It's all good. Of course, with my wife, the birthday goes the entire weekend. Right? It's not just, it's not just Friday, it's Saturday and Sunday, it's her birthday. So it was a lot of servitude over the weekend. Kind of glad it's Monday and she had to go back to work. But anyway, last week, sorry I was out suffering from an eye infection and I look like, Sinbad the Pirate, I guess. But, but anyway, all better, back now. So sorry I missed you last week. A lot of stuff happened, so we got a lot of stuff to catch up on. Of course, as we get ready, and we'll talk about that when we do our market update here in just a second. But, we're getting ready to head into really a very important week, really 2 weeks for the markets. First of all, the stock buyback window closes this coming week. So this week, all those buybacks, which have been near a record, are going to come to a close. Now, the reason that window closes, of course, is because we're right on the cusp of now starting earnings season again. I know we just finished it, but we're about to start it again in January. So that couple of weeks ahead of time, corporate buybacks, and this also includes insiders. So if you're an executive of a company, as an example, as the company goes into blackout, those type of things, you're also restricted from buying stock. So insider buying will also be cut back somewhat as we get ready to head into earnings season. So that's been a big driver for this market over the last month. Huge amount of corporate stock buybacks, near a record for a monthly basis that occurred. So that was a big lift for asset prices this month. That's going to come to an end here this week. Then, of course, we've also got the employment report on Friday. So if we see a stronger than expected economic report, that could certainly weigh on the markets as well because of simply the fact that the Fed might have to remain more hawkish. But then there's also Jerome Powell, because Jerome Powell just gave a speech last Friday. Now, markets ignored what Jerome Powell said at his last speech, which was, hey, we're watching the data and, if financial conditions continue to ease, that's going to be problematic. And he didn't say that in many words, but what he's alluding to is that the inflation fight is still front and center for the Fed, and that if they have to hike rates, they're still willing to do that. Now, the market completely overlooked that and actually has been pricing in about 130 basis points of rate cuts in 2024. Now, in order to get rate cuts, you're talking about inflation really starting to slow down, economic growth beginning to contract here a bit. That's certainly not great for earnings and not good for stock prices, particularly at current valuation levels. So markets really kind of ignoring what's going on behind the scenes to chase stocks at the moment. But pay attention to the Fed, because everybody's expecting the Fed to be uber hawkish at this next meeting coming for the FOMC. And I believe that's Wednesday the 13th is their next meeting. And so at that presser, Jerome Powell could very well come out and say something a bit more on the hawkish side to try to get markets back under control here a bit. So again, pay attention to that. We have the employment report, you got the Fed meeting coming up, blackout window coming in, of course, as we've been talking about now. Really this week and next week, mutual fund distributions are going to weigh on the markets as well, because again, they've got to distribute capital gains, interest, and dividends for the year. So that's going to also provide some additional selling pressure in the market. So the point here is simply this, is that be a little bit cautious being overly bullish here. And as we're going to talk about here in just a sec, markets are a bit extreme. But again, lots of stuff to catch up on, after the last week or so. But again, we're starting to head in that last couple of weeks of December. Now, look, the bullish trend is still there, absolutely. So let's keep watching that. Now, let's talk about some of the markets. Here's what you need to know before the bell this morning. Let's start with the S&P. S&P has had just a terrific run. We're now 2 standard deviations above the 50-day moving average. That's getting a little bit extreme here. Again, and normally when markets start to trade at these levels, you're going to get a bit of a pullback. Markets are overbought, and we're very close now to triggering a MACD sell signal. So again, markets are looking to open a little bit weak this morning. A couple of days of weakness here in the market is going to trigger that MACD sell signal, and that's going to put some more downward pressure on asset prices. So again, looking for a correction here back to some level of support, probably around 4340-ish, 4350-ish on the S&P would not be surprising before you kind of get that last week of the rally for the Santa Claus rally. The NASDAQ has been under a good bit of pressure, in terms of the Mag 7. The Mag 7 has been the leader of this market most of the year, but over the last couple of weeks, the bottom 493 stocks actually outperformed the NASDAQ. So again, NASDAQ's still overbought here, but it is now triggering actually a sell signal. It is very close here to an official trigger. So keep a watch on that because, again, those Magnificent Seven, which have led the market this entire year. Now, again, look, those stocks are way ahead of everything else. But you're starting to see some rotation from those stocks into other areas of the market. We saw, over the last month, the S&P was up about 9%. The RSP was up 10%. So the equal weighted index was up more than the actual market cap weighted index. And that was because of that lag that we had coming in from those Magnificent Seven stocks as the bottom 493 actually played a little bit of catch up over the last month. But again, with that starting to settle in on a sell signal, we may see some more pressure in those Magnificent Seven stocks as the market starts to begin some type of correction here. We'll see what happens and kind of where money flows to. Speaking of RSP, and again, this is something that we've talked about, RSP now, because of that rally, is well into two standard deviation territory. Overbought. So again, market had a great return over the last month. Those stocks that have lagged all year long finally got some buying, but that's now gone a little bit too far too fast here. So again, expecting a pullback in those bottom 493 stocks as well. So it won't be probably more a broader economic pullback, market pullback when we get this next kind of sell cycle because of simply the fact that everything moved at one time. Speaking of everything moving at one time, that goes into gold as well, and crude oil also. But taking a look at gold, punched well into 2 standard deviation territory on Friday, pulling back here a bit, but again, very elevated on a couple of different levels. So gold, if you've been long gold here, great run over the last month. Again, with the rest of the market, everything else running all at one time. There was this, following that August, September, October sell-off, which put a lot of assets under pressure. Money just flowed into everything all at one time. So this everything rally has gone too far too fast. So again, great rally here, but don't forget to take some profits. And that really kind of goes on a couple of different levels as well. Bitcoin's had a huge rally. It's pushing up to 2 standard deviation territory as well. Went from basically about 26,000 to 40,000 in just a month. So again, great run on cryptocurrencies, and now all the bulls are back out. And of course, now the headlines this morning, crypto's going to 100,000. We've seen so many of those headlines, just kind of fade those. Great rally here. If you're long Bitcoin, hey, great time to take a little bit of money off the table when you get a pullback, but you probably will to the mid-30s. Then you can buy some more back and trade the next rally. Bitcoin is not as overbought as other assets, but again, still a very big move in a very short time. Bonds also have had just a great move. We're up into 2 standard deviation territory. Very extended here on a couple of different fronts. Yields have fallen sharply over the last month. Again, take some profits, look for better opportunity. All this is going to work out. You'll get a pullback here. You'll get a better opportunity to put some capital to work. So again, just kind of pay attention. Market's very overbought. We're set for a correction of some sort. All we need is a trigger. What's that going to be? I have no idea. but it'll happen. So that's what you need to know before the bell this morning. When we come back from the break, lots of stuff to catch up on from last week. So again, I'll get with you on that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
I always tell when Rich is here, everything's set to short person mode. He deserves it after picking on me all week last week. So just saying. So look, just talking about a couple of things here. Again, it's been a great rally for the markets. And again, if we go back to October, we were talking about the markets in October being very oversold. Everybody was super negative. The bear market's back. Nothing's working. It's terrible, blah, 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 right? So this is the, kind of that environment where you get a rally. But we were talking about getting a rally in October, and again, a lot of pushbacks, like the market's not going to rally. This isn't going to happen. This year's different. This time's different. And then you have this very explosive rally in November, which kind of caught everybody flat-footed. Now you see retail investors are, take a look at the Reddit trades and those type of things. Those have been, over the last couple of weeks, late getting into the rally, but they've had a big move. ARK is a good example. Kathy Wood and her ARK ETF had one of its best months ever for the fund, as people were chasing those kind of beaten up, out of favor names. But again, that's the type of rally you get when you get these very explosive moves in the markets. But this is, and this is where investors now go, well, now nothing's going to stop this rally. This rally's just going to go on. It doesn't matter what the Fed says. It's just onward and upward from here. Goldman Sachs coming out and pegging higher earnings targets on for the S&P, pegging higher market targets for the S&P. And look, markets will probably go higher here. There's nothing really at the moment that is worrisome to a great degree. Yeah, there's, again, I'm not dismissing inverted yield curves and those type of things. But at the moment, in the short term, economic data is doing okay. There's nothing out there that suggests we're going to have a recession starting next month. Now, anything can happen, and this is why we have to pay attention to what the markets are doing. But, there's a lot of negative attitudes at the moment suggesting that, next year is going to be terrible, but there's not really any evidence of that. unless the Fed comes out and does something entirely unexpected and starts, continuing rate hikes another, 25, 50, 100 basis points. Then that's going to be problematic. We'll see. But it also doesn't mean that stocks just go, as we said, don't keep going straight up. You're going to get a correction and probably sooner rather than later now, get some type of pullback in the market that'll give you a better opportunity to put some capital to work if you're just patient. You haven't missed anything. And this is kind of the important cycle. Yes, we're at, we closed Friday right at this year's highs. Now, that's good, right? That's great. We've recovered all that we lost in June, July, August, September, October, and we're right back to where we were this year in July at the July highs. So that's good. But we're not above the all-time highs in January of 2022. We're about to go into January of 2024. And, this is an important fact that, we've talked about here on the show before, and it was interesting. I made this comment on Twitter on Friday. Actually, on Thursday. Because on Thursday, November the 30th, the market closed at exactly, well, not exactly, it was 0.8 tenths of a point different from where it closed November 30th of 2021. So for 2 years, the market went nowhere. Now, we're still not at all-time highs. We're still lower than we were. Right now, we're still lower than we were in January of 2022. The important part about that is that you have made no money over the last 2 years in the markets. Now, this is on a buy and hold basis. And this is always the important thing that people forget. So if you're, this is where we talk about financial planning. We talk about these other things that we do. And, a lot of online calculators and, a lot of people I talk with, they say, well, if I just get 6% a year, I'm going to make, whatever the number is. By the time I retire, I'm going to be fine. Well, the problem is you don't make 6% every single year. Markets don't compound. And the problem, and of course, I put this out on Twitter and I said, just proof here that markets don't compound. It's been 2 years of zero returns. This was on Thursday. And immediately everybody comes out and says, yeah, well, you had a great rally this year. It's made up for it. No, didn't. And here's why. If I needed 6% or 8%, whatever your number was in 2021, and I needed another 8% in 2022, and I'm just now back to where I was, right? That's fine. I've had no return. I've spent all year making up losses. That's fine. Nothing wrong with that, right? But those 2 years of 8% growth that I didn't get, I now have to make up. So it's 8% from the year before last. It's 8% from last year. So now next year, I've got to make 8% plus 8% plus 8%, right? Just to get back onto my goal. And this is the problem with all these online calculators and everything else that say, just plug in your annual rate, expected rate of return, and you'll have a 98% chance of success of retirement. And it all sounds great, but the problem is markets don't work like that. And so perspective, as we've talked about before, is always extremely important. Yes, the markets have done great this year, but they're only making up losses. And what's interesting is that in 2022, the market was only down. It was down about 18.5%-ish after dividends. The average retail investor was down about 35. So for them, the market index and what's going on and what happened in their portfolio are two very different things. And this is because the decline in 2022 was mitigated by the Magnificent Seven. They held up the markets. This year, they led the markets. So if you weren't just invested in 7 stocks, you likely had far worse returns in 2022 and mediocre returns in 2023. Makes a big difference where your plan turns out. And this is why, when you have these big rallies, it's important to understand that, you're going to get a correction of some sort. Now, that doesn't mean, it's always interesting. I've talked about before, I do kind of a weekly spot on Fox Business News with Charles Payne. And it's always interesting because he's always very bullish and very optimistic, as he should be because he's in the media, right? So, it's important when you're in the media to be bullish because people want to listen to optimistic, bullish stuff, and that's great. And so it's always interesting if I say something like, hey, we're going to have we're due for a correction, those type of things. It's to me like, oh, well, why are you so bearish on stocks? Like, oh, I'm not being bearish. It's just that nothing goes straight up forever. You're going to get pullbacks, which will give you a better opportunity to put some capital to work, right? And that's what we're talking about here. The markets have gone very far, very quickly. You're going to get some type of correction. And when you get that correction, you're going to get a lot of bearish headlines coming out for whatever reason. Whatever's causing the correction is going to be met with bearish headlines. And it's going to be important to realize we're just going through a correctional cycle. It's not the beginning of the next bear market, so don't go make any extreme changes. But have some extra, this is why you want to take some profits now, raise a little bit of cash, and when you get that pullback, then put that cash to work. So if you want to buy some more Apple or whatever, then you can do that, right? Whatever stock you want to buy. And markets are going to rotate as we go into next year. What worked this year may not work next year. What didn't work this year, like healthcare, may be the leaders next year. Outside of the couple of companies that are in the healthcare space, like Eli Lilly, that make these weight loss drugs, healthcare in general did not do well this year. It may do great next year. Markets tend to rotate like that, right? Energy didn't do great this year, but it did great last year. So, and this is why, one thing we talked about before is always be careful about chasing last year's performers, right? It's like, oh man, energy did great in 2022. I got to get into it because, it just did fantastic, right? And this is kind of this theme that we go through every year. I need to buy gold miners because they did great last year and then they do terrible this year. Whatever it is, right? There's generally chasing last year's best performing class is not really a great idea. That doesn't mean you have to go sell last year's best performing asset class either, but just expect there to be a degree of underperformance in the coming year. If they were last year's leader, if they were last year's laggard, I would expect a year of outperformance. But again, some of that has to do with what's going on economically, what's going on with interest rates. There's obviously an issue with commercial real estate. So, real estate's been under pressure in general. And generally, when you have something under pressure, it's kind of baby out with the bathwater. The entire sector does poorly. But again, that will change. And real estate's going to be a great performer at some point. So this is why you always have to kind of think ahead. Don't focus about what happened. What happened in the past is irrelevant. It's over. Can't change it. Can't do anything about it. But be aware as you move forward of avoiding last year's underperformers. Oh, that did terrible last year. I don't want to own it. I want to own what did great last year. And this is what most investors do is they jump from whatever the hot performing fund was last year. They want to go pile into that mutual fund or that ETF, whatever it is. So they want to chase that just about the time that rotates into being an underperformer, right? So just be a little bit cautious here. But there are certainly some interesting rotations that are occurring right now. And the question is whether or not they're sustainable. And we'll talk about a couple of things when we come back from the break. So thanks for joining me this morning. Be right back after the break on The Real Investment Show. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, ads declare, I plumb miss that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Rhett, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You know, my kids are at the age now where they still send Christmas lists, and my wife and I just laugh. So she and my two daughters, they want a pair of Ugg slippers, and you can't get them.
The Real Investment Show podcast. Same show, your schedule.
These Uggs, you cannot get them anywhere. It's like, well, you're going to get the knockoff brand.
Instead of Uggs, you get Oops.
You get Oops. Exactly.
At realinvestmentadvice.com.
You get what they're actually called, Uglies.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So as we kind of get ready to wrap up this year, obviously December tends to be one of the stronger months of the year. And again, following a very big November, December tends to be on the positive side. But you know, part of this is that some of that Santa Claus rally is now kind of behind us. It kind of got pulled forward because of the big sell-off in October. So, you know, the December gains may be somewhat more muted. You know, it's not entirely unreasonable to expect a correction here, as we've been talking about, and then a rally into the end of the year as you do kind of window dressing for the winter. We kind of wind up right where we are now. So maybe December winds up to be positive, but only barely. So we'll see. I mean, you know, anything's possible. But, you know, this is just kind of where we are within the cycle. But, you know, once you start kind of getting out into next year, this is where, you know, allocation is going to become a bit more tricky. Recession talk hasn't fully abated yet. It will most likely in the next, you know, couple of months, 3 months. We'll see. That's depending on how economic data does. So if economic data continues to kind of stumble along here and kind of what we call muddle through, it's not great, but it's not poor. It's just kind of average. then you're going to get less and less recession talk kind of in the economy. And a lot of that's already died down. So, we had a lot of recession talk back in 2022. 2023 was going to be the recession year. Didn't occur. 2024 is going to be the recession year. It hasn't occurred yet. We'll see. But if you get through most of 2024 without a quote unquote recession, it'll die down. People will stop talking about it as much. Now that's going to be a kind of a benefit to asset prices once you kind of get that risk off the table, if that's the case. The other side of this is, of course, is the lag effect, right? So even the Federal Reserve keeps talking about, and Jerome Powell on Thursday talking about this lag effect in the economy, and that it's not fully priced in yet. So they're expecting slower economic growth. And that's one of the reasons that they've kind of been on hold with rate hikes over the last, really since July with their last meeting where they hiked a rate. They haven't done any since. At the time, though, in June, July, August, September, October, interest rates were going up, asset prices were going down, and that was doing the job of tightening monetary policy. That's now been seen a very large reversal, right? So we've completely wiped out the hike in interest rates on like the 10-year Treasury, went from 5 to 4.2% in a month. So saw a big recovery and asset prices were back to the July highs, the last time that the Fed hiked rates. So everything that had happened during the summer of tightening those financial conditions, which would put pressure on the consumer, has now been completely reversed in a month. Now, one thing that Jerome Powell said, and this was when he gave his speech last week, and this was very telling, and again, something that we've talked about here on the show, is that I'm a little cautious about Jerome Powell right now because of the fact that as you start to look into where we are currently and taking a look at these financial conditions, et cetera, all of a sudden, he's not in as good of a position as he was just a month ago. And this is something that was in the Financial Times actually this morning, was an article and talking about Jerome Powell and what's in, and I'm trying to find this exact quote. Give me 1 second here. Yeah, here we go. This was a statement from Powell on Friday. He said it would be premature to conclude that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. We are prepared to tighten policy further if it becomes necessary. Now, that's a pretty clear message that, they're willing to continue to hike rates here if the markets don't start behaving a bit. The markets are pricing in 130 basis points of rate cuts as of Friday. So again, we talked about before, why would the Fed cut rates? Well, the Fed cuts rates when you either have, economic weakness heading towards deflationary pressures. The Fed doesn't want deflation, right? They do want inflation, and want inflation running at about 2%. They don't want deflation. So they're going to cut rates if they start seeing recessionary pressures, much weaker than desired economic growth, right? Economic growth below 2%. They don't want that. Or if there's some type of financial strain, credit markets, et cetera. So that's why the Fed would cut rates. They're not going to cut rates just because. And if the markets are rallying and loosening financial conditions, and again, this is, we've talked about this a lot of times before, is that, Ben Bernanke 2010, that the reason they do QE is to raise asset prices to boost consumer confidence, which feeds into the economy. So if rising asset prices boost consumer confidence, and if we see an uptick in consumer confidence, that's not what the Fed wants to see in order to cut rates. Now, they may not hike rates, but they may not cut rates either. So this is all kind of potentially setting the markets are kind of setting themselves up for disappointment. We saw this a lot in 2022. Markets would rally, and then the Fed would have to come out and go, hey, we're hiking rates more. We're not near done yet. And then the markets would sell off. And then the markets would start rallying again on expectation that maybe the Fed was done. And then the Fed would have to come out and say, nope, slap them around a little bit. We're not done yet. And so the markets have been doing this to themselves over the course of the last couple of years. Jerome Powell's kind of in the position of the beatings will continue until morale improves, right? And the markets aren't getting that message. So the point here is this is one thing just to be a little bit aware of. That when we talked about this, that Fed meeting on next Wednesday, I would not be surprised. I'm not saying he will. Right? I'm not saying he's going to, do anything out of the ordinary because he may see something else going on in the markets or the economy that we don't see. But I just think there's a higher than likely probability that he's going to have a kind of refocus on this statement that it's too soon to speculate on rate cuts. In other words, their job on fighting inflation is not done yet. So again, that recession talk is going to be important as we get ready to go into the next year. And again, I've got an article coming out this next week talking a little bit more about this. But Friday's article was just a review of our recessionary indicators. And those recessionary indicators are not, getting any better, really. We are seeing a bottoming in some of these indicators. Like leading economic indicators as an example, they are showing a bottom. But we're still in negative territory. We're still at levels that are normally recessionary in nature. We haven't had a recession yet, but they're there. A lot of the manufacturing indexes have gotten softer. ISM manufacturing last week was actually weaker than expected, came in at 46.7 versus 47.5. Still in contraction territory. So there's the inverted yield curve still inverted, right? We haven't uninverted yet. And that's a key because it's the uninversion of the yield curves that typically coincide with a recession, not the actual inversion. So there's still indicators out there saying, hey, a recession risk is likely. And I think that's something you can't dismiss entirely. Particularly where interest rates are right now and considering the amount of debt that people have, and there's not really any new round of funding or stimulus coming into the economy at this point. We'll see. But these are the things that I think are important. So with that in mind, right, a couple of things to be mindful of technically. The S&P Equal Weight Index, which has been the big laggard this year, is the most overbought it's been since the summer of 2020. And that's happened in a month, right? It was just a massive flood of money. We're coming off a period of historic, kind of easing. That collapse in yields was a very dramatic decline in financial conditions. That decline in interest rates, that decline or that increase in financial easing, right, led to the rip in equities. But the question now is how much further can yields fall in the current environment? Now, if you get into a recession, yields are going to go towards 1%, right? So they've got a long way to go. From 4.2 to 1 is a long way to go. But they're likely not going to go there right now. And especially if the Fed's not going to hike rates, I would expect that rates are going to go up over the next month versus, the probability is higher interest rates over the next month or two versus lower. Because rates are so overbought right now. Bonds are very overbought right now. Sentiment index, the bullish retail investors are back as bullish as they've been at any previous market high, going back to July as a good example. They went from uber bearish in October to uber bullish in a month. So again, just be careful. If you're super bullish on the markets right now, this is a great time to take some profits, kind of rebalance your portfolio a bit, have a little bit of extra cash on the sidelines. Then we'll figure out what to do next. Okay, come back. We'll wrap up the show. Talk about what's coming up this week. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So a couple of things here real quick, just as we kind of get ready to, launch into this week. Futures are down a little bit this morning. Not surprising again at all. But a couple of things. Really don't have much in the way in terms of earnings. About the only notable company out today of any consequence is GitLabs. But outside of that, we're really kind of wrapping up earnings season. We have factory orders out today. October is expected to be a negative 2.7% versus 2.8%, positive 2.8% previously. So we'll see if factory orders are slowing down any. Durable goods orders for the October month final reading there at a negative 5.4% in line with the previous announcement. Tomorrow, of course, then you've got a few more earnings tomorrow. Sana, AutoZone, Box, Dave & Buster's, Designer Brands, Smuckers, Neo, Toll Brothers. But we're getting ready to wrap up. I'm pretty much the vast majority of the market has reported earnings. So it'll be just kind of a dribble on earnings here for the next really couple of weeks as we get ready to wrap up the month. But the big numbers are going to be the ISM Services Index, which is tomorrow. So we had manufacturing on Friday. You have services tomorrow. Services remains in expansion. Now, this is an important thing, right? So a lot of the read on ISM manufacturing, a lot of people talking over the weekend, like, the manufacturing index is still in contraction territory, recession coming, et cetera. You got to be careful with that. Manufacturing only makes up about 20% of the U.S. economy today. It used to be 80% back in the 70s was manufacturing. Today it's about 20%. Services makes up about 80% of the economy. So if you want to take a look at the read on the economy, and when we use this composite, I've run this composite before for you on the show and articles I've written on the website. It's part of our economic composite index that we produce on a regular basis. But if you take a look at the composite index, now you have to weight that index. 80% services, 20% manufacturing. If you weight it relative to the economy is doing okay. Now, it's not doing great, right? But it's slightly positive. It's slightly above contraction. It's like 50.2. It's right on the line, but it's still in an expansion territory. So services are key to where we are because we do so many, we do so much more in services. Everything that you do today pretty much is a service type thing. So we just don't have that much of a dependency on manufacturing more because we've outsourced so much of it. But, services drive the economy. So if that number comes in, it's expected to come in at 52.5 versus 51.8. Give that an 80% weight, 20% to the manufacturing number, you're still doing okay. And then, of course, Friday is the big employment number. That's going to be the market mover. If that number is super weak, again, we have a very weak number like we had last month. That's really what sparked this rally in November was that much weaker than expected employment number, which immediately moved the market into expecting Fed rate cuts. So if the employment number comes in stronger than expected on Friday, that's not going to be great for stocks because that's going to put the market back on, the Fed's going to have to keep either hold rates here or hike rates more. And that's going to be right ahead of, and look, and Jerome Powell already has this employment data, right? Which is, I think, why he made the statement that he made on last week, talking about, the economy's not anywhere near the place that we need to be for cutting rates. They're still focused on rate hikes. And I think he already has the employment number, so it's either in line or not terrible. Is the point. But that'll be a big mover. If that number surprises the entire market to the downside, much weaker than expected, then I would expect a sharp rally in stocks and a decline in yields. If it's stronger than expected or in line, we're probably going to see more weakness. The risk, as we've been talking about this morning, is to the downside right now. That's where the risk is. Because the markets are just so overbought. And this goes for gold, it goes for Bitcoin, it goes for stocks, it goes for bonds. It's every asset class. It was an everything rally over the last month. It's just way ahead of itself. You're going to have a correction in all these asset classes. Just be aware. Now, again, doesn't mean everything's going to fall out of bed and we're going to be down 20% by the end of the month. That's not going to happen either. But expect a bit of a pullback, right? And then a rally into the end of the year. Still very much the case. First 5 days of January, expect a rally. People putting money to work. After that, I have no idea, right? Because, again, we're going to start getting into 2024 dynamics at that point and trying to figure out what the economy is going to do, what the Fed's going to do. We'll be back into that game again. But it's all about jobs leading up to Friday. Got a little bit of economic data, a little bit of earnings data this week. Nothing major, but Friday's the number. We'll get ADP out. We'll get jobless claims out on Thursday. Jobless claims, good example there too. Right? The initial claims each week are still at very low levels. So we're not having mass terminations, right? We're not seeing mass layoffs. But remember, initial claims are, hey, I just got fired. I go file for a claim of unemployment the first time. That's an initial claim. Continuing claims, those people that keep filing, every week or every period whenever they have to file, that number's creeping up. We were at like 1.6 million and we're at 1.9 million now. So we may not be having mass terminations at this point, mass layoffs, but people aren't getting hired back. So they're hitting their initial claim and then they kind of disappear into the continuing claims role. And we don't pay a lot of attention to continuing claims, but that number is ticking up. And that's something worth paying attention to because that generally precedes an uptick in the unemployment rate. And we're getting to that point in those continuing claims that you're about to start seeing potentially a sharper uptick in the unemployment rate going into next year. We'll see. Outside of that, as there's not anything. This really kind of been a boring couple of weeks, right? I mean, I've actually had trouble writing stuff over the last really 2 weeks because there hasn't been anything just falling out of bed that it kind of warrants attention one way or the other. Everything's kind of gone quiet for the most part. It's been a very strong, like I said, obviously very strong rally, but there hasn't been a big driver, right? So it's been tough to write, blog posts, et cetera, over the last, week or so, because it's been this very kind of muted environment. It's kind of a wait and see thing. And, eventually something's going to come out of bed and we're going to have to, we'll obviously have stuff to talk about, but it's just been very boring. There's not been, there's still a lot of people running around, waving their hands, hair on fire, et cetera. But it's just been tough to find something interesting to write about. That's why we wrote about the stock market correction before the year-end rally on Tuesday. We updated recessionary indicators on Friday because it's just nothing going on at the moment. I think we'll have something over the next week or so. We'll have plenty to write about, but it just hasn't happened yet. So anyway, a couple other things, just kind of general house cleaning as we get ready to wrap up the year. If you need to do RMDs, do it now. Those are your required minimum distributions. Don't wait till the last minute. Every advisory firm, us included, we get very, first of all, we try to let our staff off to have holidays like everybody else. And so they want to be able to enjoy their holidays. So if you need to do RMDs, if you need to do, IRA contributions, whatever it is that you need to do before the end of the year, do it before the end of do it now. Don't wait until the last 2 weeks of December when right in the middle of the holidays, like, oh yeah, I need to do this because, you may have trouble getting it done because people are going to be gone on the holidays and, they're going to be backlogged because most people wait till the last minute. So if you want to make sure and get it done, do your RMD now. If you need to open an account, do it now. If you need to fund an IRA for this year, whatever, do it now. Just go ahead and do some of those things now sooner than later. Don't wait till the very last minute. You'll appreciate it. They'll appreciate it. And it'll make sure it gets done on time. There's always this big mass rush on the 30th of December. It's like, oh, I've got to get this done. It's like, you run the risk of not getting it done before year end if it needs to be done. So just be aware of that. Be nice to your advisor. They will appreciate it. So we are about to get into a stretch of holidays here. Obviously, Christmas coming up, the New Year's right around the corner. So market volume is going to lighten up here a lot over the course, really starting about December the 15th. Market volume is going to lighten up a lot because most of your professional traders are going to be out on holidays. As we talked about before, they run off to the Hamptons and they're spending their weekends. So that's going to lead to potentially increased volatility. And that's why you also have these potential drawdowns in the first couple of weeks of December. As we talked about, mutual funds make their distributions, but they're also making their distributions into lighter volume equity markets, so which potentially leads to more volatility. So, very quickly too, mutual funds. Every year I get a rash of people emailing me about how their mutual fund had this massive drop in one day this time of the year. That's because of the distributions. Don't freak out. If you own a mutual fund, those investments with 5 letters on them, if you own a mutual fund and it's down like $1 one day or a full percent or whatever, that's the distribution coming out of the fund. You'll get the cash in a couple of days, or you'll get the shares if you're dividend reinvesting. But don't freak out over a big decline in your mutual fund that doesn't correspond with the market. That's just the distribution. All right. Have a great day. We'll see you back here tomorrow for the next edition of The Real Investment Show. Be sure to go by the website, like the channel, and subscribe. We appreciate it very much. Get by the website. We've got new blogs coming out this week. Everything's back in action now that I'm back from being the one-eyed pirate for a week. So we'll see you tomorrow.